Good afternoon. Today I am going to again discuss the corporate taxation. Last Saturday we discussed the nature of the company, what definition of the company, and also the how to compute the extraordinary income, assessable income, and taxable income. And also we discussed what are the deductions from the extraordinary income. Before that we discussed how to compute the extraordinary income. Extraordinary income, again, the extraordinary income of the company is computed based on the aggregate amount of all source of income. Then after computing the extraordinary income, some deductions are allowed. The deductions are losses and interest payments. Then we arrive to the assessable income. After computing assessable income, the taxable income of the company is computed. The taxable income is computed after deducting some qualifying payments and donations. The donations, as we discussed, and also I have given some Word documents. In that documents, I have specified the deductible restriction of the qualifying deduction, and also the amount qualified for the deduction. After deducting all the qualified payments and donations, then we arrive at the taxable income of the company. After computing the taxable income, we apply the applicable rates for the company. They depend on the nature of company. In Sri Lanka, there are a lot of the tax rates are there for depending on the nature of business. Some SME tax is tax at rate of 12%. Also apply for a certain profit on some businesses like alcohol, tobacco, and betting and gaming levy. The special thing is any profit on income arises from business of betting and gaming, and also the selling of liquor and tobacco. Profit is taxed at rate of 40%. That is special tax rates in order to collect more revenue and also discourage that type of business. Right. Today we discuss more on the corporate taxation. We have to learn some important section of the inland revenue. The learning of that section and the definition is more important for us to understand the interpret the tax in institute, and also the any tax in institute like value add tax, ESC, or the Nation Built-in Tax Act. Any extraordinary income consists of a lot of words. For that words have different meaning. In taxation, some word is defined one way, and in other act, the same word is defined other way. The Agriculture Act defines the agriculture in some way, and the Taxation Act, Inland Act defines the agriculture in other way, and therefore we must have some understand about the definition and also the imposition of the taxes. Then in the first place we learn how to compute the income tax liability to the individual. When the individual tax liability is normally computed, aggregate of the all source of income, and we compute the statutory income, and same way we compute the assessable income and also the qualifying payments. Then question arises, on what section income tax is charged for individual and also the companies. Then there may be some certain law, they without any ambiguity. This must be clearly stated in the Act. The imposition income, this is the very important section of the Inland Act. Not only in the Inland Act, even turnover, even National Building Tax Act, Value Added Tax Act, the imposition section is very important. Again, today also I am going to highlight the imposition of income tax. The income tax shall, subject to provisions of the Act, be charged at the appropriate rate, especially the first, second, third, fourth, and fifth schedule of this Act. Then we must hear each and every words have a different meaning. For every year of assessment, Commission on or after 1st April 2006, in respect of the profit and income of every person for that year of assessment. Here only words the year of assessment after 1st April. Then we must know about what is the year of assessment. Here no any reference for the year of assessment. That means what duration of period is considered for the year of assessment. And also profit and income also has not defined here. Only income tax shall be charged from the profit and income from the every person. Then who are the every person? Then we must have a clear knowledge of the person to person. Then we can impose the tax for the person. Again, who is a resident in Sri Lanka? There the person also. Some is in resident in Sri Lanka, some are not in resident. That part we call the non-resident. The B says the arising is derived from Sri Lanka in the case of every other person. The A says wherever arising in the case of person who is resident in Sri Lanka in that year of assessment end. Here normally its general meaning is who is resident in Sri Lanka, immediately come to our minds the individual. No, here the wherever arising in the case of a person who is resident in Sri Lanka. In other arising no derived, here the special reference dictionary is the A. Whatever arising in case of person who is resident in Sri Lanka in their assessment and arising A, the where, not the whatever, the where, that means within Sri Lanka or the outside Sri Lanka. In case of resident reason, any income arising in Sri Lanka or the where in Sri Lanka. That means the world income is subject to tax. But in case of non-resident, the B says arising derived from Sri Lanka in case of every other person. Every other person means the non-resident. The A says the resident person, in every other person means the non-resident. Then in case of non-resident persons, their income derived from Sri Lanka is subject to the taxes. In case of non-resident, they are on other income arising from other countries, the other tax jurisdictions are not subject to tax in Sri Lanka. Take individual Japanese fellow in Sri Lanka and he has a bank deposit and also business. Then if any profit derived from that business or the interest, he has to pay taxes in Sri Lanka. This is the same Japanese person. If you think that he has other business in Japan and Korea and derived some profit, but that profits of Japan and the Korea derived from that country, but in that profits are not taxed in Sri Lanka. But in case of Sri Lankan individual who is resident in Sri Lanka, if he has a business in Sri Lanka and also he has a business in Japan or India, but profits are derived from that business, but he has to pay tax in whole income. But the Act says that income tax shall subject to the provision of this Act. Then all the foreign income of the residents are not taxed, because the Illinois Act contains some exemption provision. On that exemption provision clearly indicate any income derived from outside Sri Lanka brought to that profit through a bank, then profit is exempted. That's why the imposition section says the income tax shall subject to provision of this Act be charged. Then the exemption are there within the Act. Then tax shall not be charged on that occasion. The imposition, the 2 says for the purpose of this Act, profit and income arising or derived from Sri Lanka includes all profit and income derived from service rendered in Sri Lanka, from property in Sri Lanka, from business transactions in Sri Lanka, whether directly or through an agent. The says arising or derived from Sri Lanka includes. There are some cases, some individuals are not present in Sri Lanka, but their properties are in Sri Lanka. Says from some shipping companies, they are renting their ships to Sri Lanka and getting some rent income from that property, and also some foreign person has holding some properties in Sri Lanka and they are renting, but that properties, any income derived from that property is subject to taxes. Then here the again applicable rate is specified in the first, second, third, fourth and fifth schedule to this act. If we are going to then we learn to how to compute the taxable income of individual, and also we learned how to compute the taxable income of the corporates. Then we have to find the what rates to be applied to compute the taxable income. Then for a corporate taxation, fifth schedules given lot of how to the tax rates applicable to each type of business. Right. Then again the very important section words of the imposition section, the person. Then the word person has been defined in the section 217. The section 217 given lot of definitions for the words. Here again the person includes a company or body of person of government. So now according to the imposition section, tax shall be subject person to be charged at the appropriate rate in the first and second, third, fourth and fifth schedule to this act for every year as one commencing on or after April 1st, 2006 in respect profit and income every person here, right? Every person. You can find the word of person, right? Then we have to find who are the word person have been defined in the section 217. Here the person include company or body of person or any government. But how we are going to tax for individual now? Question arises. Here the person includes. That means there may be other persons also. Now individual also come to the meaning of the person, right? Now company. Now we can tax any company incorporated in Sri Lanka and derived as profit. Then they have to pay tax. Why? The person, every person include the company also, company or body of person or any government even. Right now, the tax can be imposed to the companies under the Inland Revenue Act under section 2, right? The section 2 is the very important section of the Inland Revenue Act. The section 2 given the authority of the tax department to impose, Commissioner General to impose the income tax for the person. The person, the word person has been defined. Then we discuss some non-resident person. The individual, the person, here the include. There may be other inclusion also. At least all these to be include. Then individual also come to the definition of the person. Even non-resident individual also come to the definition of the person. Non-resident company also come to the definition of the person. On that basis, we can impose the tax for the companies and also the individuals. Then again, the word company and again defined in the same section of 217. Here the special distinction is the person start from the includes, right? But here the company, the word the word of company is defined. Start company means, right? There are special. We must distinguish what is the distinction between different includes and the meanings. If the any after the words in definition section word after the word it is start from the word of include, that means there is a exhaustive definition. There may be other things also come to that definition. That again, as I said, the word person include, then individual also come to that definition. Even foreign and Sri Lankan and also foreign individual also come to that definition. The word company means, then therefore no other company should come to the GP. Only this mean this, the company means, there should no any other inclusion for this one. Only for means any company incorporated or registered under any law in post Sri Lanka or elsewhere, and include the public corporation. Here only the company incorporated in Sri Lanka under the Companies Act, or if some companies are registered in other countries, and or but includes public corporation, right? Now you know, even in Sri Lanka, a lot of public corporations are engaged in the business. If you take Sri Lanka Broadcasting Corporation, they are doing a business and they are making profit for accepting advertising and broadcasting advertisement. In Sri Lanka, there are three TV channels. They also accept advertisement and broadcasting advertisement. For that purpose, they charge and they are making profits. Take the very big company business of Sri Lanka, the largest business of Sri Lanka, the Sri Lanka Petroleum Corporation. That is a government or public corporation. The company is the corporation making profit. Very recently, paper advertised the last year the Sri Lanka Petroleum Corporation profit is exceeded 8 billion rupees. But any profit, according to the Inland Act, any profit derived from Sri Lanka are subjected to taxes, but there is no any exemptions. But now, if someone asks question from you, on what basis the public corporation profit are taxed, we know that according to the word, according to the imposition section of the tax is charged from any person who is resident in Sri Lanka, and also if any income derived from Sri Lanka. If any corporate doing business in Sri Lanka and derive profit, then subject to tax under the meaning of the company. The word person include the company. The company means any company incorporated or is under any law in Sri Lanka or elsewhere, and includes a public corporation. Now we know how to tax. Now public profit of the public corporation also can be taxed under the inland revenue tax. And why? The imposition of income tax, the section 2 is permitted to tax the profit of a person. The word person includes the company. The company also means the public corporation. Then again, the word public corporation also has been defined in the Inland Revenue Act. The public corporation means any corporation, board, or other body which was or is established by under any written law other than the Companies Act. If any company is registered in the Companies Act, it is come to the meaning of the company. Companies Act number 7/2000, with capital wholly or partly provided by the government by way of grant, loan, no other form, not the from other form. Other form. Right. Other form, right. Then say in Sri Lanka, we all know Ceylon Electricity Board, right? Then this board also sometimes make a profit, sometimes they are having losses. The lottery boards, Sangardan, there are a lot of boards in Sri Lanka and they are engaged in the business and they are making profits. Then if someone asks on what basis profit of the electricity board is taxed, then they have to give a clear meaning. Then we say under the imposition income tax, as profit of every person is, the income tax shall be charged from the person who is resident in Sri Lanka. Then we can say the person include the company. The word company include the public corporation. The word public corporation include the anybody. Any means any corporation or body which was is established by the under any written law in Sri Lanka. All the state bodies have been established under Parliamentary Act, and that basis profit and income of public corporation also is taxed under the income tax. And on what basis? The section 2 of the Section 2 of the Illinois Act, that is the Imposition Income Tax Act, permits to tax the profit of the statutory bodies. Now we know the word person include individual, and on such basis individual profits and income are taxed under the Illinois Act, and also profit of the company also tax according to the meaning. The word the person include the company include all the companies incorporated under the Companies Act, or the incorporated in other countries and other law, or the including public corporation. The public corporation also defined again, and then public corporation includes means the any statutory body. Then we know the Illinois Act permit to tax all these entities. Right? These definitions are very, very important. Wherever in the context in the body of the Illinois Act, each and everywhere these words are appear: profit and income, the word person are stated and described. Then we have to go for this meaning. On that basis, we have to interpret the words. Right? Then there are again the section 3 of the Illinois Act. We learn the source of income, profit from employment. Under section 3A, we learn the profit from trade, business, profession, or vocation, profit from employment, rent, interest, dividend, royalty, annuities, winning of lotteries, like that. We learn lot of source of income. Then profit and income means then this word profit and income is appearing in the Illinois Act elsewhere in body. If you read this Illinois Act, you can find the word always the word of profit and income is appeared and is specified in each section. Then we have to define the profit and income according to this meaning. Profit and income means the net profit or income from any source for any period calculated according to the provision of this Act. Here also profit and income means the profit and income from any source. Now we know the source of the Illinois Act. Here we know the source of income are the section 3 of the Illinois Act define the source of income. Right? Then the profit means the any source. Then trade. Then we know the profit or income means the net profit or income from any source for any period calculated according to the provision of this Act. Then there are a lot of provisions in this Act. Now section 25 and 26 say how to compute the profit from trade. Section 26. Then section 25 permit to some permissible deduction, but all the any expenditure incurred for the production of income can be deducted, including the any expenditure specified in the section 25. Right? But section 26 include some disallowable expenditure. After adjusting an allowance, all those expenditure we are calculating the profit and income from the business or the for a trade or the business. But if you are going to calculate the profit from employment, then we learn cash and non-cash benefit are taxed. Here now see the profit and income is the net profit and income from any source. If is there the word income from employment, then according to the provision of this Act means then section 4 specified how to compute the profit from employment. Now according to provision of the Act, we know any other way. We always have to adhere the meaning of the provision, the relevant provision. When we are going to calculate the profit from income, we have to read we have to refer the section 4 of the Illinois Act. On that way, we have to compute the profit from employment. Likewise, rent income also the Illinois Act says the profit from rent is computed based on after deducting 25 rates and after deducting 25% of repair allowances. Then the Inland Act specified how to compute the profit from each and every source. For that purpose, the relevant sections must be referred to compute the profit from any source. Then, when we compute the interest income, then question arises: the income to be calculated according to the provision of this Act. That interest income, how to compute now according to the Inland Act? The section 25 4, subsection 4 says no any deduction for the interest income. If it is so, in case of interest income, gross interest is taxed. No any deductions are allowed. Right. Now again say the important section say the word year of assessment. Now we learn how the meaning of how to compute the period year of assessment. The word year of assessment also defined in the Inland Act. Year of assessment means, but we can't include any other 12-month period. Only for a 12-month period commencing on the first day of April and any year of and ending the 31st day of the March in the immediately succeeding year. But here again the word trades is meaning definition is starting word includes, but here you can easily find year of assessment. After the year of assessment, the word year of assessment start the word of means again. Then that means we can't induce any other dates. Only for a 12-month period to be computed on the first day April of the year and in the 31st day of the March of in the immediately succeeding year. Right. Now profit. Now we know the definition of profit and income. Now other very important definition is for the business. Here again, the word business starts with the includes, not as the word means. The includes mean an agriculture undertaking, the raising of horses, the letting or lease of any premises, including land by a company and the property. Right. Here the business includes. Here now say, if we are going the profit of the textile business is tax. Now here the business of the word include. Then all other business come to the definition of the business. We all know that all these are business, but we have to take agriculture undertaking also. If someone is doing a plantation or the nursery, then that type of business undertaking also come to the, though it is agriculture, come to as a business. The raising of horses also. Again, the letting or leasing any premises including land by a company here. Right? It is become the business. Say if there are very section is very, very important. If the individual person let this additional house for a rent and earning some rent income, that is not become the business. That type of renting a house by an individual is not come to the meaning of business. That is come to his rent income. Then the way of profit is computed, we allowing rates deduction and the 25 of repairs allowances. But in case of the company, say here the word, the letting or leasing of any premises including land by a company, then again come the as a business. Say last day also I discussed some in Sri Lanka, some property development companies. They also develop the properties and they are renting and they are deriving rent income. But by a company, these are registered companies. those companies have been registered under Companies Act. They are shareholders. Then they are doing it as a business. The end result will be loss, or sometimes maybe the result may be a profit. We got my experience in some property development company in Sri Lanka. In initial stage, they incurred the losses. But in case of individual, if we put up a building and rented it out and earn some rent income, if his income is computed, first we take the gross rent and allow in rates and 25 the repair allowances. Then definitely there will be a profit or the income. But in case of a company, the same thing was done, but if they have put up a building and rented it for outsiders and derived rent income, and then they deduct their all expenditure, ultimately result would be loss. Then in such cases, such type of letting of leasing of any premises, if done by a company as a business, then we come with the profit from trade or the business, but not at the rent income like individual. Right? There is a special difference. Only difference in this case, when we come with the profit from the property development companies, if they engage in the leasing or the renting of premises, the deduction of repairs allowances, if they are incurred more than 25% of the gross income, we limit it to the 20% of the gross income. Say if the company has within the year of assessment 2014 and 15, their gross income is, rent income is 100 million, and they incurred the repair allowance expenditure of 30 million. If the repair expenditure of 30 million was incurred, but according to the accounting standard, they have to charge for P&L, but profits to be computed in accordance with the provision of the Inland Revenue Act. Then they have to the repair expenditure is limited to 25% of the gross income. Then 25% of the gross income, 100 million, equal to 25 million. If the company incurred 30 million, but according to the Inland Revenue Act under section 26, they only allowed the 25 million since the income tax, the expenditure has been incurred. Then the balance 5 is disallowed. Right? Only difference is there. Now we see what is the meaning of the trade. The section 3A, when we read the section 3, the profit from any trade, business, profession, vocation for however short period carried on exercise. The section 3A, the profit is included for the business or the trade. Again, the word trade also again defined. The trade again include, there may be so many different type of trades, but include trade, every trade and manufacture and every adventure concerned in the nature of trade. Then we must learn adventure and concern of the nature of trade. If the period is short, even if they have done the trade to make for a motive of make a profit, then that type of activities come to the meaning, includes the meaning of trade. Again, there may be any type of trade is, any type of profit arises from any type of trade is tax, subject tax, but the word trades includes any manufacturing. Then say if some profit of a manufacturer is taxed, say if take Ceylon, some steel manufacturing company registered on the Companies Act, derived profit from the manufacturing business, then on what section we tax? Then we say the profit from any, the word profit from any trade is come to the definition of section 3A. If it is a company, it is goes the meaning of the person. then is a manufacturing business because includes the word trades. The profit from trade is going to tax. The manufacturer profits also come to the definition of the trade. Here again, every adventure and concern in the nature of trade. In some cases, there are some people or the companies engage 1 or 2, 3 transactions and they are making profit. In that one also come to the definition of the trade. Very recently, the very first day we defined the word in Sri Lankan decided cases or Swameeswaram versus Commission of Inland. In that case, the particular party bought a land from a party and they block out and sold and make a profit. Then that within a very short period they made a profit. That was the only transaction that they have done during that period. Only they bought a land and sold it. Land also bought also under the agreement without paying. Only they paid the advances. They collect from the other. They collected for money in advance and paid to the seller, and but ultimately results was they end up with the heavy profit, and they kept the landlord for their own use. According to the Inland Act, that type of adventure and concern is the nature also come to the definition of the trade. Every adventure and concern is the nature of trade. That type of adventure, they in the Rameswaram case, these people they are adventure in the nature of trade. Right? Then within shorter period they concluded the transaction, they made a profit, and that profit source subject to tax in Sri Lanka under the meaning of the under the source of section 3A, under section 3A. Right. Today in corporate taxation, we are going to study the dividend taxation also. The very first day I explained that in corporate taxation, company taxation, any company has to pay income tax on their profit, that means the taxable income of the company, and also if any dividend declared, they have to pay dividend tax of 10%. If any company declared the 100 million of profit dividend for its shareholders, they have to pay 10 million of dividend tax to the tax department. If the 100 million is distributed by way of dividend, 90 million to be gone to the shareholders, 10 million go to the tax departments. The applicable rate is now current is 10%. By recent budget, the dividend tax was increased to 14%. Before loan Sri Lanka dividend tax rate was 15%. Then it was reduced to 10%. Now in recent budget, the dividend tax rate was increased to 14%. That rate is effective on the year of as well 17 and 18. Up to 16 and 17, the rate of 10 is applied for the dividend tax. The rates depend on the prevailing situation. Now the prevailing rates is 10, but from 17 and 18 dividend tax rate is 18. But if the government next budget the minister increase to 15%, that means for 18 and 19 year of assessment, dividend tax would be 15%. Right? Therefore, we must vigilant for the tax changes announced by the Minister of Finance of their annual budgets. Now, then now I explain that corporate and all the companies are liable to pay income tax on their taxable income and also dividend distribute. Now we must know about the word dividend has been defined in section 62, but now here the word dividend has been defined in the section 217. Now dividend include, there may be other way include any distribution of profit by a company to its shareholder in the form of money or an order to pay money, share in other company, in any other company, or debentures in that company or any other company, distribution or dividend spices, especially where company buy back shares from its shareholders, the excess, if any, paid to any shareholders or the market price of such share quoted in the Colombo Stock Exchange or the market value of such share, as the case may be, at the date on which the shareholder of such company at the meeting approved such share buyback, and the amount of any capital return or distributed to the extent of the paid up value of the shares distributed by the company to its shareholders. Likewise, word dividend has been defined. Normally in Sri Lanka, lot of companies paid dividend in cash. That means the shareholder received the checks. If any shareholder were entitled to 1 million of dividend, he received the 900,000 of checks, and the dividend note calculator says 100,000 is gone to the tax department as the dividend tax. In some cases, it is debentures. Even the company has always dividend is distributed from the retained profit of the company. The company can buy other company shares and or that must be transferred to the shareholders of the company, or even company can issue its own debentures to its shareholders. It also become the dividend. Share buyback is a very recently introduced section definition for the dividend. Only in this session we are learning then we can apply all this type of payments to shareholders as dividend, but here we learn for any dividend paid by way of money or the order to pay money, right? The word dividend also declared. If someone is finding some accounts, this company has made a huge profit and retained their business, and also they have not paid any dividend to the shareholders, or say without getting dividend, if the shareholder is the 1 or 2, the family concerned company, they can buy that profit by your loan. Then how do we apply the taxes? The company has more retained profit. To avoid the dividend tax, they are not declaring dividend for its shareholder, only for a 2 shareholder of the company, the public concerned company. But still, since they control the business, the passing resolution or not, they can borrow as the loan. In such situation, how to tax? But I am going to teach that also under the other topic, the how to tax on such situation. But directors are taking loan from the company without declaring dividend. Right? These are very. The word dividend also very important definition under the Inland Revenue Acts, right? Say, then we learn there are definitions for the profit and income, and also that was in this definition section 217, but section 107 also defines some word. In the body also, in some section itself, defines some word. In section 107, the word net profit is defined. The definition is net profit in any trade, business, professional occupation means net profit ascertained in accordance with accepted commercial practice and accounting standard. Say the profit and income, the word is defined. The profit and income is net profit or income from any source for any period calculated in accordance with the provision of this act. Then for a profit from trade we apply section 25(6). Say for employment income we applied section 4. For interest income we apply section 25(4). But here the net profit, this section 217 defines the word profit and income. 107 only defines the net profit. Net profit in any trade, business, profession or vocation means net profit asset in accordance with the accepted commercial practices and accounting standards. Now, in Sri Lanka, Institute of Chartered Accountants has formulated some accounting standard and they are published in the gazettes. Now, in Sri Lanka, there are different type of businesses: banking businesses, leasing businesses, plantations, construction business, normal manufacturing. Say, if we take a bank business, bank and financial service business, then or the leasing business, their income is generated through as a interest income. But same way, the individuals also depositing their excess money and receiving interest income, right? If it is a business, right, then in bank, interest income is recognized as their turnover. They lending money to his customers and they charge interest. But in banking hat, that is their gross turnover. For deposit holders of the bank or the financial, they pay interest. That is their expenditure. In addition to that, there are other intermediate cost by salaries, electricity, all other business expenditure. If you take a leasing business, leasing also, the companies, they normally lease rentals are collected by the leasing companies, but according to the accounting standard, the only interest income is recognized as their gross income, not the total lease rental. For a purpose of value-added taxation, interest plus capital is subject, total value is subject to value-added taxation. But for income taxation, according to the accounting standard, profit is computed only consider the lease interest income. But for taxation, leasing income is adjusted for a again for a net profit we added the capital portion on their tax computation and allow the capital allowance for the leasing assets. On that way, different methods are applied. For a leasing companies, net profit is computed in accordance with the accepted commercial practices and accounting standard. Tax profit is profit and income for taxation is computed in accordance with the provision of the Illinois Act. According to the provision of the Illinois Act, total lease rentals is taken as income and also capital allowances are allowed for the lease assets. On that basis, profit is taxed. In case of plantation companies, also any expenditure income of plantation are allowed. Even in some cases, some capital expenditure also allowed according to the Illinois Act, right? In some cases, in the construction companies, net profit is ascertained. Say in some large construction projects are taken longer periods. Sometimes the project is the time take for more than 3-4 years to complete the entire projects. But in that cases, according to the percentage of construction completed, profit is ascertained according to the accepted commercial practice and the accounting standard. Though the full project has not been completed, the percentage of completion and value is taken and some profit is applied according to the accounting standard, and accordingly profit and that profit is adjusted with the provision of the Illinois Act and tax rates applied and tax liability is computed, right? And therefore, the word net profit is very, very important for the ascertain the adjusted profit for the taxation purpose. Say if any company has not ascertained the net profit according to the accepted commercial practice and accounting standard, then we might, then they are not declaring the correct profit for its owners or the shareholders. Especially the listed companies has to follow this accounting this accepted commercial practice and accounting standard. If the accounting standard does not allow to charge the capital expenditure, but accounting standard allow to charge any business advertisements, but on that basis profit can be ascertained. But according to the Inland Act, capital expenditure is not allowed, though the company its profit charging capital expenditure certain citizens. Inland Act is not charged, but even accounting standard not allowed to charge the capital expenditure. In some cases, Inland Act allows charge some capital expenditure, especially in agriculture business for opening up the agriculture for land for agriculture. Then even capital expenditure was allowed, but according to the accounting standard, no capital expenditure are allowed. But in some cases, profit is adjusted according to the Inland provision of the Inland Act. Right? Right? The word turnover. Turnover in relation to trade, business, profession, or vocation and to any period means the total amount received or receivable upon transaction entered into or for service performed during the period in carrying on no vocation. Right? Here again, word turnover also defined. Here the special reference is any amount received or receivable. Right? That means since that word turnover defined to catch the accrued basis, though the amount is not received, even accrued basis turnover to be asset, even on that basis credit sales are taken into account. If any company prepared their account without taking the receivable balance or the not following the accrued basis, then department officers have the right to apply that basis and accordingly profit to be adjusted. Right? Therefore, and also the word turnover is more important to compute the profit of the SME sector. Now, according to for the word SME is only for your general knowledge. The word SME has been defined in different different method. But for central bank define the word SME sector according to the applying some criteria. In some criteria is usage of the electricity, or in some SME is defined based on the capital assets and the plant and machinery usage of their business. In some cases, some define the SME based on the number of person utilized on the business or the employed on business. According to the Inland Act, there is no clear definition for the SME, but SME for a taxation, we have given the turnover. If the company's turnover less than the timeline has been changed up to 2016 and 17, if any manufacturing business turnover is less than 750 million and profit of such undertaking was taxed as concession rates, we are treating as the small business. Prior to that, the Inland Act defined turnover SME based on the annual turnover less than 500 million for the manufacturing or services business other than retail and wholesale trade. Again, with recent budget, the SME categorized on the basis of if the annual turnover less than 500 million, but for 17 and 18 year, the SME concession rates apply for if the manufacturing or service business, if their turnover less than 500 million, they can pay the tax and concession rate. And therefore, word turnover also very, very important section of the Inland Revenue Act. Right? Now, corporate taxation. Say, is a very, very important section for a income tax administration of the companies. Say, if we take an individual, if his income is exceed for a year of investment 500,000, he has to voluntarily goes to tax department and get the registration number, and he has to pay taxes under self-assessment. Right? But if then we know definitely the responsibility is the particular person. If Mr. Perera started a business for last year, and he has for that business he derived profit more than say the 500 million for say the for a year ended that 31st March 2016 they made a profit of 1 million. That means he has exceeded the 500,000 of threshold. Then he has to pay taxes. Then Mr. Perera's responsibility is to get the registration number and pay taxes to the department. That means the responsibility goes to the individual. If take the partnership business, the president partner's responsibility is to if the partnership made a profit and he start to pay tax. In likewise corporates. Now we are learning corporate taxation. If any company registered under Companies Act and their memorandum article and the article associations, they give the name of the directors and the shareholders, and also the company there will be some chairman or the managing directors and the executive directors. In addition to that, all the corporates have their own secretaries and also they employ some executives. On that basis, in case of individual control the business, and for a tax responsibility also come to the same individual. In corporates, now question arises to whom responsibility is gone. If any company make a profit, the profit is subject to taxes according to the meaning of the Inland Revenue Act. This is, as earlier I explained, the company come to the meaning of the person, and also profit and income include the words profit and include the profit from trade and business profession or vocation. On that basis, if any company engages in trade or the business, profit is subject to tax under the Inland Revenue Act. Then whose responsibility is get the registration number for the taxes, and also the quality for income for a corporate taxation also for a company has to pay taxes in quarterly basis. Not only for income tax, they have to discharge other tax liabilities likewise value-added taxes. If there are more employees, then they have to deduct the PAYE taxes. If in case of banks, once the interest is paid to deposit holders, they have to deduct the withholding tax for their interest payments, and also if they have value-added tax registered company, they have to pay the quarterly and monthly basis. The way applicable is apply in the relevant period. They have to pay the value-added tax. On that basis, then we have to, in corporate taxation, we have to check to whom responsibility is gone. The annual return must be filed, accounts must be prepared and submitted to the tax departments. Value-added tax return must be filed to the tax department. Relevant schedules to be filed to the tax department. For each case, the due dates has been specified in the particular tax statute. For in case of income taxation, for any year of assessment before 30th November of the succeeding year of assessment, return must be filed with the tax department. All the taxes to be completed before 30th September the next year of assessment. Likewise, then and also if any taxes has been not paid by the company, then that not paid tax become the taxes in default. Then when the recovery actions are taken by the department to whom the relevant notices are issued by the department. On that basis, in corporate taxation, then we have to check to whom responsibilities are gone. The 100 section 4 is recovery of default taxes. That means, say that if any company has the tax liability for 2015 and 16 for 100 million, if they have only paid 50 million, not paid 50 million, then not paid 50 will become the taxes in default. That means that he has not paid tax. Any not paid taxes we define as the taxes in default. Then department has to take recovery action for that defaulted taxes. Say that if you read this section 174, where any person, including director or principal officer of a company, a partner partnership, say here, any person in case of individual, the individual is responsible. The director or principal officer of the company, or partner, if it is a partnership, partner is responsible for the submission of make payment of default taxes. Again, where any person, including a director or a principal officer of the company, or partner of a partnership, or member of an office bearer of an unincorporated body, in respect any income taxable by such person, including a company, partnership, or other income body, has defaulted in payment of such tax due, and where such default continue period exceeding 36 months, the Commission General shall submit to magistrate certificate containing the relevant particulars, include the amount of tax in default, the period of default, and accrued penalty and interest. Such person, include director, principal, partner, member of an office bearer, as the case may be, shall be liable on conviction after summary of trial before magistrate to a period of imprisonment of either district and not exceeding 3 months. I have quoted this section here, give some insight for a responsibility of the company, to whom responsibilities are gone. Here only I took the, if any taxes has been default, if the department is take legal action to recover that taxes, to whom legal action to be executed. If we see individual, say if Mr. Perera has defaulted taxes, we can execute a legal action against the Mr. Perera. His name and address are there. If it is a partnership business, the Perera and Silva partnership, is a Mr. Perera is the president partner, then we can issue the notices to the magistrate, state the name of the president partner. But if we take a company, the company, say the shareholders or the directors and separated from the company, right? The tax has, if the tax has not been paid, the default tax are assessed the name of the company, not the name of the directors. The directors of the company, they draw the director salaries and they pay tax for their director salaries. If any they have defaulted for payment of their income, then their name, the recovery action can be taken again before the magistrate. But in such cases, if any company has defaulted in tax payments, then legal action can be executed name of the director or the principal officer. But in Sri Lanka, there are two cases. The company has not paid their taxes, but legal action was taken against the directors. MBG Silva versus Commission of Inland Revenue case, the legal action was taken against the directors for the recovery of taxes. But court took a view, directors, for a director's personal assets, default tax cannot be recovered. The department took action to recover the default tax of the company to assess of the directors, but court decided default tax to be collected from the person the income has duly assessed. In corporate taxation, profit is assessed to the hand of the name of the company. Then any assessed of the company, then the department can seize and recover the taxes. If the legal action are executed to recover the tax from the director personal assets, the court decided the department can't recover the taxes from the personal assets of the company directors, but directors are responsible to payment of taxes, right? But take now in case of default tax recovery, the sections are uncertain. But say take that if they have not furnished their return of income on due dates, the legal action can be executed against the directors or the principal officer, and therefore these sections are very important for the corporate taxation. There are many definitions in the section 217. If the body consists some word, if there is no clear understanding about for the reader, then he must check whether the definitions have been given in the definition section, and therefore when we read the Illinois Act, we must give more importance for the definition section of 217. If any definitions is not there in the body, then we have to go for a section 217 and we can find the definition for the particular words. Right, now we must we got some insights regarding the definition of words of Inland Act. Now again subject to the corporate taxation that last day we discussed up to how to compute the taxable income. Special difference of the corporate taxation versus individual taxation. In individual taxation, interest for individuals, the interest income is not subject to taxation, not forming part of the statutory income or the assessable income if the withholding has been deducted, even treasury bill or treasury bond. In corporate taxation, interest income become the part of the statutory income. Again, the special differences is we have to gross up the interest income, and gross interest income is forming part of the statutory income, and then we compute the assessable income and taxable income, and all profits, then taxable income include interest income is taxed the rate of 28%, and withholding tax or credits are allowed for the deductions. Withholding tax in corporate taxation, any corporate deposit in their excess money in banks or financial institutions, 10% of withholding tax are deducted. Last day we taught how to compute the notional tax credit on treasury interest income from treasury bill and bonds. Right. Again, in corporate taxation, 3 types of taxes are involved. One is income tax on taxable income of the company. Other tax is dividend tax on the dividend tax distribution. 10% of dividend tax, dividend distribution, not the dividend tax. If then say if any company made the taxable income of 100 million for 200 year of assessment 15 and 16 for 100 million, if the company is taxed at the rate of 28, they had to pay the corporate income tax of 28 million. Right? Right. 28 million. Say within the Europe assessment 15 and 16, the company has distributed dividend of 25 million for its share. Then they have to pay 2.5 million of 10% of dividend tax. But in addition to that, in corporate taxation, if a company has not distributed any dividend for its shareholders, then deemed dividend tax has to be paid by the company. If any company has not distributed dividend for its shareholders, if they have a distributable profits, then they have to compute the deemed dividend tax and pay to the tax department. Now, in corporate taxation, three type of taxes are involved: corporate income tax, dividend tax, and deemed dividend. Deemed dividend tax is computed on from the distributable profit. Right? Right. Then, first step is now deemed dividend tax is applied where a company not distributed its retained profit of the previous year at least 10% on or before 30th September next year of succeeding year of assessment. If you take, if the company has made a profit of 100 million for year of assessment 14 and 15, if the company made the profit of 100 million for the year of assessment 14 and 15, based on that profit, after computing distributed profit according to the Inland Act, they arrived say the 80 million of distributed profit. If they have not distributed 1/10 of the distributed profit, that equal to 8 million on or before 30th September 2016 for a previous year profit, means the year of assessment 14 and 15 profit for a distributable profit, the company should declare at least 10% of its shareholders on or before 30th September of the 2016. Then the company has to pay deemed dividend tax of the distributable profit. If a company at least distributed 10% of distributable profit, then no deemed dividend tax has to be paid. If any company has not declared any dividend of less than 10% of the distributable profit, then company has to pay deemed dividend tax. For that, the first step to compute the deemed dividend tax is compute the distributable profit. Right, for a short break, we stop the presentation. Right, after 15 minutes, again I start the presentation. මේක අර මේ වායනේ නේද? ලියර එකේ නෑ නේ.
මොකද?
අර වගේ ඇඟිල්ල ලියන්න.
ඒක දැන් එන්න සර් මේක
දැන් එනවනේ. හරි.
ඒක ෆුල් ස්ක්‍රීන් දාන්න ඕනේ නැත්නම් හරියන්නේ.
එතකොට මේක ආපහු මම කරන්නේ කොහොමද? එතෙන් ආපහු අතෙන්ට යන්නේ ආයෙත් මෙතන මම කරලා. ඈ?
කොහොමද තියෙන්නේ?
ඔව් හරි. මේක ඇල්ලුවා. ඊපස්සේ
යට චූට්ට යන්න නෑ ඔබගෙන ඉන්න.
ඒකේ මේ ඇඟිලි තුන ගන්නවනේ. හරි. ඒතර මේ එතකොට මේකනේ. මේ මොනවාද? දැන් පෙන් එක ගත්තා. පෙන් ගත්තා. පාටක් ගන්න ඕනේ. හරි. දැන් ගන්න බලන්නේ. ඊට පස්සේ මේකට ගියා. ඉරියක ගත්තා. හරි.
හරි. එතකොට මේ
ඒතර මම
නවතිනවා මේ එක මෙන්න.
ඇත්ත. මම මොකද්ද කරන්න ඕනේ එතකොට? නවත්තනකොට
මෙතන බ්‍රේක් එක මෙතනින් මේ පෝස්ට් රෙකෝඩින් කියලා තියෙනවා.
එතන හරිනේ. හරි. ඊට පස්සේ ආපහු ඒක වුණාම හරිනේ.
ඔව්.
හරි. ඊදර පස් දෙනා දෙන්නේ.
ඔව්.
හතරයි.
තුන් දෙනෙක්.
හතරයි නේ.
හරි.
හරි දැන් නේ. බලන්න මේ වෙනවද කියලා නේ. right. හරි. පොඩ්ඩක් බලන්න දෙන්න බෑ. හරි. ඔය තමයි හරි. right. 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 Let us start. Then again, I wish to emphasize that in corporate taxation and company, in some cases, they have to pay three type of taxes. One is the tax on income tax on taxable income. Second is if any profit is distributed by way of dividend to shareholders, then 10% of dividend for the dividend amount of dividend distribution. Other one is if the company has not distributed 10% of the distributed profit of the previous years, or if they have distributed less than the 10% of the previous year distributed profit, the excess amount up to 1/3 of the previous year distributed profit, then they have to pay dividend tax. For always, again, there are some computation methods are involved for the dividend tax. Dividend tax is charged on the distributable profit of the previous year. Then we apply in section 25 and 26, taking the book profit of the company, we adjusted in accordance with the provision of the Land Act, that means section 25 and 76, we adjusted the business profit. The profit means, as we learned today, profit ascertained in accepted commercial principle of practices of accountancy. On that basis, companies are preparing their accounts for the purpose of taxation. Profit is adjusted in accordance with the provision of the Inland Act. That means allowing deductible expenditure specified in the section 25 and not limiting the expenditure restriction the expenditure is specified in the section 26. Likewise, then we compute the statutory income as well and taxable income and we apply the rates. Likewise, for to compute the deemed dividend tax, first step is compute the distributable profit of the company. Then always again, this must be kept in mind, deemed dividend tax is applied if the company has not declared the at least 1/10 of the distributable profit as computed based on the previous year, and or if the company has distributed less than the 10% of the distributable profit of the previous year. In such situation, deemed dividend tax has to be paid by the company. Now we are going to learn how to compute the distributable profit, right? The first step is, again, the deemed dividend tax is computed based on the previous year profit. 1/10 of the profit to be distributed based on the previous year profit on or before 30th September of the next year of assessment. Then, in such situation, then for a computation of distributable profit, we have to take the book profit of the previous year. Then adjustment are, again, before the dividend tax concept is explained, I want to highlight stress here that always dividend is distributed on the retained profit. In some cases, there may be tax losses if when we adjust the 26(5) and 26, and also when we allowed the deduction from the statutory income and the taxable income as qualifying payments, there may be no any income tax payable, but still company has a retained profit, company can declare dividend. In case of, if the profit is exempted from income tax, no any income tax, but the company has to pay dividend tax on the dividend distribution, and also if they not paid 10% of dividend tax on the distributable profit, then they have to pay deemed dividend tax. Then the deemed dividend distributable profit is computed based on the previous year profit. First step, we take the book profit. Then we adjust we deduct tax on taxable income. If you paid some taxes for a previous year, that amount is deducted. And also cost incurred in acquiring land or capital assets, even land. That means if the company has incurred some cost for acquiring land or the capital assets, that full amount also allowed to deduct from the book profit. And also the profit included revaluation reserve in the profits. Say in some cases we know the immovable properties are value and take in the profits, and also in some cases put in the revaluation reserve. If any revaluations are included in the profits, that is also deduct, especially in revaluation of the shares, in the market value. Normally companies are revaluing, if there is any profit they put in as a revaluation. Like that, if there is any, there is no, these are nominal and the realized value. This type of method was introduced in order to collect the taxes from the companies where the company has the cash flow, and also consider on that basis we have computed their cash flow position. And in revaluation reserve, no any cash is generated. That's why that type of part is removed from the book profit. Then there are three type of deductions are there: tax on taxable income, cost incurred in acquiring land or capital assets, and also the revaluation reserve included in the profit. After deducting, then again we have to add some amount. Depreciation of such capital assets. If we check the P&L, the depreciation is charged for assets bought in the previous years also. There will be big amount. But here we added only for the depreciation relevant to the capital assets purchase during the period. That is the cost incurred during, we say, in such case the cost incurred for acquiring, say, take the 30 million of fixed assets purchase, then only for if the company's policy is 10% of depreciation, only for a 3 million charge for a PLA. That 3 million is added to the profit. There may be assets purchased prior to the next year and prior years, then big amounts would be charged as depreciation, but full amount is not added only for a such capital. This word of such capital is very, very important. Why? The accounts carries the big amounts, but when we make adjustment, we have to take only for a depreciation relevant to the capital asset purchase during the period. There is a cost incurred according any land and capital assets. And again, at the revaluation loss charge to the profit. Here, the same method, same principle is adopted. If the revaluation reserves is included, we remove it, and also revaluation loss is charged. They have, then that is we added, because no, in that claim in the revaluation they have they can reduce their book profit, but that if the revaluation loss has been charged to P&L, that profit, that loss is added to the book profit. On that basis, distributable profit is computed. Only this is the method, very easy method. Only for 5 items are only involved. In lot of cases, revaluation reserves and the revaluation loss cannot be found on the accounts. In some, there are some cases. Now we check how to compute we take some example and check how to compute the deemed dividend tax. So, income statement of company for the year ended 31st March 2004 shows the net profit of 100 million. Following additional information is available. Company has acquired the capital assets for sum of 45 million during the year ended 31st March 2014. The depreciation charge to the income statement of 40 million include the depreciation in respect of the capital assets referred to in above amounts of 5 million. Right? And very right. Income tax liability for the of the company on taxable income amount of 30 million for the year of assessment 13 and 14. Assuming that company has not declared dividend during the year of assessment 14 and 15 before 30th September 2014, determine the distributable profit of the company for the year of assessment 13 and deemed dividend tax liability for the year of assessment 14 and 15. Since the company has not distributed dividend during the year of 14 and 15 based on the previous year profit, then we have to compute the distributable profit, right? Why? The company has not made any distributable, not distributed any declared, and there, if the company, say in the particular example, if the 100 million of profit, if the company has the 10% of equal to 10 million has been declared, 10 million and more declared, no deemed dividend tax come for a. If the company has declared at least 10 million on or before 30th September 2014, no deemed dividend tax comes from this company. But in this case, in this example, company has made 100 million of profit, but one tenth of the profit is 10 million, but no any 10 million has, at least no 10 million of dividend has been declared before 30th September 2004, which come to the year of assessment 14 and 15. Then dividend tax have to be paid in the year of 14 and 15. Why? Within the year of assessment 14 and 15, company has, before that date, this date 30th September 2014, dividend has not distributed. Right. The book profit of the previous year is 100 million. These are the adjustment. The tax on taxable income, tax on taxable income 30 million. Cost of fixed assets purchase 45 million. In this case, no revaluation reserve. Then we add all 75 million. We less this 75 million, then balance residue is 25 million. As I explained, this 45 million depreciation 40 million includes only 5 million of depreciation relevant to the capital assets purchased during the period. Only that 5 million is added. Then we take the amount of distributable profit 30 million. Then since the company has not declared at least 10% of distributable profit of previous year on November 30th September 2014, 1/3 of the profit is we take to compute the deemed dividend tax, not the 1/10. Since they have not declared 1/10 of the dividend on November 30th September of the next year of assessment, we take 1/3 of the distributable profit and apply the rate of 15. For a deemed dividend tax, the specified rate under the 11th rate is 15%, not the 10% of deemed dividend tax rates. For a deemed dividend tax is computed at the rate of 15 for the distributable profit. In this example, we arrive the distributable profit based on previous year profit. We arrive the distributable profit of 30 million. Since the company has not distributed 1/10 of the profit on the previous year distributable profit, that means at least 10 million, company has to pay deemed dividend tax of 1.5 million for the distributable profit of 1/3 of distributable profit of 30 million, that is the amount equal to 10 million. Why? The only reason, mere reason, the company has not declared at least value of 10 million, 1/10 of the distributable has not been declared. We will take other example. A company distribute slides. This slide example, company distributable profit for the year 14 is 30 million. Determine the minimum dividend payable for to the shareholder to earn such profit to avoid tax on distributable profit for the year of assessment 14 and 15. Again, the company's distributable profit for after adjusting tax payable, capital assets purchase, and also depreciation charge and revaluation reserves, for a distributable profit computed was 30 million. Now we know the distributable profit. Then we are asked to determine if the company has to avoid the dividend tax for the year of as a 14 and 20, what is the amount of dividend to be declared? Right. Then we know the relevant law. To avoid the dividend tax, company should declare at least 1/10 of the previous year distributable profit. Then 1/10 equal to the 3 million, right? Then 3 million, if the company has declared 3 million. Right. Answer is 3 million. If the company has declared at least 1/10, then to avoid the income deducted tax on the distributable 30 million, they should have declared at least 3 million. That means 1/10 of the 30 million is equal to 3 million. If the company, then in this situation, if the then company paid 300,000 applying rate of 10%, if they have paid 300,000 of dividend tax, no dividend tax come. Now we say the situation where that company has distributed less than 1/10 of the less than 1/10 of the no distribution, no any dividend is distributed. We take though the company has made the 30 million of profit distributable profit for the previous year, no any dividend is distributed. Then as I said, then we take the now situation is the earlier in this example, company has to avoid the dividend, company has comply with the law and declared 3 million avoid the dividend tax. Now we will take the situation where no dividend is distributed for a previous year profit. Now we know the applicable law is if no any dividend is distributed, we take 1/3 of the distributable profit and apply the rate of 15. Again here earlier also we computed such a profit. The 30 million 1/3 is 10 million. For 10 million, if we apply the 15%, tax is 1.5 million. Right? Then they had to pay, at least they would have distributed 1/10 of that equal to 3 million. On November 30th September, they would have to pay 300,000. Since they have not distributed 1/10 of distributable profit, they had to pay dividend tax was 1.5 million. That means 5 times they had to pay. Right? There are other situations. The company has distributed only for 2 million. Distributed dividend of 2 million. The company distributable profit of the previous year was 30 million. Now, to avoid the dividend tax, they would have declared at least 10%, the amount equal to 3 million. But the company has declared only 2 million no before 30th September 2014. Then the company, since the reason of not declaring at least 1/10 of the distributable profit of the previous year, company has to pay dividend tax for a failure of the not declaring dividend for a 1/10 of previous year from distributable profit. In such situation, dividend has been computed. First we compute the, now first thing is, since they have not declared 1/10 of the distributable profit of the previous year, first step is we take 1/3 of the distributable profit. The 1/3 equal to the 10 million. 1/3 equal to 10 million. Right? 1/3 of distributable profit equal to 10 million. Then, but company has distributed 2 million. Then we deduct that 2 million. Then we arrive the 8 million. Again, the distributed profit for the previous was 30 million. But since the company has declared only for 2 million, that means below the 1/10 of the distributable profit of 3 million, then company has to pay dividend tax excess over the 2 million and over the 1/3 of the distributable profit. Then we first step is we compute the one third of the distributed property is 10 million. The company has declared on 2 million of dividend. Then we arrive the 8 million. For that 8 million, the company has to pay 15% of dividend tax. Then come to 8 million into 15% come to 1.2 million. Now all the scenarios I have explained. No, if to avoid the dividend in first example, to avoid the dividend tax, company should declare 1/10 of the distributed profit. In this question example, I have asked to avoid the dividend tax. What is the minimum amount to be distributed on before 30th September 2015? 1/10 equal to the 3 million. In this example, if the company has declared 3 million and more, no dividend tax come. In this example, no dividend distributed or dividend distributed 2 million, that means less than the 1/10 of the distributable profit. Then dividends apply, especially this second situation, distribution of dividend 2 million, that is below the 1/10. Then the applicable formula is 1/3 is first compute. In some students, in my experience, they compute 1/10 of the 3 million and deduct the 2 million. For 1 million, apply the 15%. Then answer is wrong. That is the mistake the students are making. For where the situation of dividend distribution less than the 1/10 of the distributable profit, they take the difference and 1/10 difference over the 1/10 and the dividend declared and apply the 50. That is wrong. If any situation where dividend distribution is less than the 1/10 of the distributable profit of the previous year, we take the 1/3 of the distributable profit and deduct the amount of dividend distributed and apply the rate of 15. Again, in this example, the company has made 30 million of profit, distributable profit, but at least they would have declared 3 million, 1/10, that means equal to 3 million to avoid the dividend tax, but company has only declared 2 million, that means less than the 1/10, then the company has to pay, then dividend tax come into play and company has to pay dividend tax. Now is second distribution, in where situation that the dividend distribution less than the 1/10, then dividend has to be computed. The method is, first step is we come with the 1/3 of the distributable profit and less the dividend distributed. In this example, 1/3 equal to the 10 million, dividend distributed 2 million, the difference is 8 million. For 8 million, we apply the rate of 15 and then they have to pay 1.2 million. On that way, dividend has to be computed. Now we learn how to compute the distributable dividend tax for the distributable profit of the previous year. Right? Right. Right. Before explain to this tax rates and all, I like to explain that for a corporate taxation, here we learn how to compute the income tax, corporate income tax, dividend tax and dividend tax. For that purpose, we got the taxable income, dividend declaration and also the distributable profits. There are some situations, some companies, directors are not declaring dividend, though they have a huge amount of retained profits, without declaring dividend, and also they are paying very less amount of, they declared only for a 1/10 of the profit as by way of dividend and above the dividend tax, but they take large amount by way of loans. Say company has made, there are some situations, take the company has made 1,000 million of profit, 1,000 million of profit. Avoid the dividend tax, only they have to declare 1/10 of the distributable profit. Say take the distributable profit was computed, it come to the, again, say for example, distributable profit for the previous year was 1,000 million, then avoid the dividend tax, only he has to pay dividend, declare the 100 million of dividend, and they pay 10 million of dividend tax and avoid the dividend tax. Say same year, before they declaring, only for declare 1/10 of the distributable in order to avoid the dividend tax, he borrowed 300 million by a loan. If we would have to borrow, now he has taken from the company 400 million, dividend of 100 million and 300 by way of loan. But if it is a company, since it is a company, that as a shareholders of the company, the director is a shareholder of the company, he should have taken out that 400 by way of dividend. But in the particular, as my example, he distribute dividend of 100 million, the 300 million was or taken out by way of loan. Now there he has not paid any taxes, but Indian Act provided to extract some tax on such situation also, because we know the director as shareholder, he should have taken out the profit by way of dividend. Instead of, since the company has made, as my example, 1,000 million of profit, he borrowed the 300 million by way of loan without declaring dividend up to the 400 million. In such situation, department can form an opinion that though you have taken out the profit by way of loan, that is also deemed as dividend. You have taken out the dividend, but only you label as it as a loan. Since the company's retained profit is available, you took a loan, you withdraw the cash of the company by way of loan, that is equal to the taken out the dividend of the, that means he enjoy the profit, but he should have enjoyed the profit by way of dividend, but he enjoyed the profit by way of taken a loan. In such situation, we deem director has not taken a loan, we deem he has taken a profit of the company, and such situation, the department deems such loan as a dividend. That concept we call dividend deemed to have been distributed. Say in the particular example, say that the company director as a shareholder has taken a 300 million by a loan, department can make a opinion that you have taken the profit of the company, that profit we take as a dividend, then we assume that dividend deemed to have been distributed by the company, and in such situation department can assess the hand of the shareholder or the company, that dividend tax of the dividend tax on the dividend deemed to have been taxed over the company. Whereas situation that company directors have borrowed the loan where the retained profit is available with the company for the distribution, such profit loans is treated as a dividend deemed to have been distributed and apply the rate of 10, because in the dividend is taxed at is maximum rate of 10 of the according to the current applicable law. That means in the particular example as I have given for a, the company has made a profit to 1,000 million, but only for a declared 100 million over the DD tax. We borrowed 300 million. That 300 million he has to pay again 10% of the 300 million. They have to pay 30 million of dividend tax. Right? That not the dividend tax. With that tax, again he has to pay dividend tax. That tax we call dividend. We tax assess on the meaning of dividend deemed to have been distributed. This provision is not applied by the department, but section 66 provides to collect some taxes for the taxes from the shareholders where they have taken out the profit by way of loan, and therefore law is available, and therefore always we encourage to companies to distribute the dividend by way of dividend and enjoy the profit of the companies and not take the by way of loan. There are some other situations of the corporate taxation. The very special section of corporate section in corporate taxation, section 67 of the Land Act number 10 of 2006. There are some in some lot of family concerned companies in Sri Lanka. Lot of private companies incorporated under Companies Act controlled by the two family members. Family members, they control according to as they wish. Right? In that sometime in some companies with the sales, some sales amounts without taking as turn of the company, directors take it out. In some cash sales, they are not gone to the books of accounts and they are taken out. In some time, they introduce some expenditure headings and taken out the money. Say they put casual labor expenditure of 10 million and labeled as sufficient charge in profit and loss account, but directors enjoy the money. Likewise, when the purchases, they introduce bogus purchases. They purchase the value of 100 million, put in some commission paid to purchase, they charge another 10 million and taken out. By that, by several devices means, directors or shareholders or managers of this, executive managers of these companies are appropriate the company's fund. Company, that means they steal the company's fund or the profits. That means in Indian Act use the word of appropriated. They appropriate the funds of the company and utilize. They say, for example, the company director, he undisclosed sales, cash sales, he utilized to purchase a land and construction, right? But if say the department receives some if the department receive information, one of the directors of the company has purchased a land value of 100 million and put up 200 million worth of house, and that expenditure incurred for 300 million for the period, the department receives the information. The department calls information from the particular director, explain how he has earned this money. But only he has say, when we check his income tax return, individual return, only he has declared, say, deduct POs of 5 or 6 million, 5 or 6, oh, he has not borrowed any loans. Then question is how he had spent the 300 million of for the purchase house, land and the construction house. Then through the investigation, if we find he has misappropriated company funds, then according to the director's hand, that 300 million can be as though the company directors or the shareholder executive directors appropriated the company's funds, that amount is treated as a profit and income of the directors or the managers or the shareholders. If they can appropriate any funds of the company or steal the company's funds, then it becomes profit and income of such director or the shareholder or the manager who appropriate the such funds, and therefore according to the shareholder's hand, income is assessed as profit and income, though he has appropriated the company's funds, and therefore provisions are available in the Inland Act tax any situation the company's profit has appropriated or the not distributed or took by way of taken out by way of loans. Any situation relevant tax can be collected from shareholder or the directors or the executives or the managers of the company. Right? There are in taxation, as I explained, there are some non-corporate taxation. We know there are some companies are incorporated in outside Sri Lanka, and also they come to Sri Lanka and doing business, and they derive the profit. According to as today, as President I has explained, according to the imposition of taxation, in case of other persons, any income derived on Sri Lanka or property in Sri Lanka is subject to tax. Say if any foreign company come to Sri Lanka and establish branch office and do the business and make profit from Sri Lanka, then they have to pay taxes in Sri Lanka. Why? According to the imposition of taxes, according to section 2, any income derived in Sri Lanka are subjected to tax in case of non-residents. The resident, wherever arises or derived, are subjected to taxation in Sri Lanka. But in case of non-residents, any profit or income derived in Sri Lanka or any profit income derived on any property situation in Sri Lanka, then say in such situation also they have to pay taxes for their taxable income is computed based on the provision of the Inland Act, and when we compute the taxable income of the non-resident person, we apply the relevant rates, and now we have to check how to compute. All non-resident person, they make business here and derive profit here and they taken it out. But we learn in Sri Lankan, in resident companies, if they take their profit by way of dividend, they will collect the dividend tax. Now we have to check. One the foreign company come to Sri Lanka and establish branch and did the business and full profit is taken away to their country, then we have to collect the dividend tax. Say the one company come to Sri Lanka and made 100 million of taxable profit, and same full profit is taken out to their country, then in such situation we compute income tax on taxable income, and also then we deem full profit is taken away by way of dividend. But the act, we define it as a Remittance Act. Section 62 of the Inland Act very clearly defined that tax on taxable income and tax on remittance tax at rate of 10% to be charged to the non-resident persons. Take the one company, say the company made a profit of 100 million and they have to pay 10% of relevant rates for income, apply relevant rate for income tax, and we deem the full profit as taken away, then he had to pay other 10% of taxes after deducting the income tax paid by that person. Say if they have made 100 million of profit, if say apply 28% of income tax, they have to pay 28 million. Their residue is 72 million. That 72 million is taken in out or the remit to their own country. That 72 million applied 10% of remittance tax. But that we label as the remittance, not as the dividend tax. We always, if the non-resident person doing business here and full profit is taken it away after paying taxes, the residue is taken it away. We deem that profit is taken it away. We impose the remittance tax of 10% for that. Right? There are some other areas. There are some non-resident companies. They are holding branches. They are continuously doing business here. Six, there are some foreign branches. They are continuing their operation here. They are continuously operation here. In such situation, if they are remitting money for in such situation, full profit is not full profit is we do not deem the full profit is remitted. Then we take amount of profit remitted to the is mother company or the shareholding company. But in all other cases, if very short a period they did the contract or the business and made the profit and full profit is taken it away, then we impose the taxes for the full amount of profit is taken away as a dividend. That in here in foreign tax, non-resident taxation, we use the word of remittance tax, that is equal to the dividend tax. Right. There are some other situations also to corporate taxation. If we take, there are a lot of construction companies come to Sri Lanka and they do very short a period, or some cases they continue the business. But normally they say they can't, they profit on income of Sri Lankan branch cannot be readily ascertained. That means they normally they make argument that they cannot correctly ascertain the profit attributed to Sri Lankan operation. In such situation, Commissioner General can apply the reasonable percentage for the profit, for the turnover. In such situation, we take the full value of the construction contract or the business value and apply the rate of at least 8% of the rates as profit and apply the rates and we can collect the taxes. Section 83 the Commissioner General has been empowered to apply the rates. Then no, it is not, the foreign unresident person is not required to prepare the profit and loss account in their business. They agree certain percentage of profit with the Commissioner General. Say that Commissioner General decide the percentage of profit based on the nature of business and considering their fact in some cases, but Commissioner General has to at least apply the 8% of the net profit for the total turnover. Normally in service sector business, the Commissioner General apply more than 8% of the contract or the business value. Right. There are some other situations also. There are for non-resident taxation. Take in Sri Lanka. In Sri Lanka, we don't have the developed shipping or airline business. Only Sri Lanka, the one operating Sri Lankan airline, and also very small of Sri Lanka Shipping Corporation, and also there are some private companies. But still, lot of ships come to Sri Lanka, and also lot of aircraft come to Sri Lanka. But coming to Sri Lanka, that aircraft or the ships, they they transport passengers, the mail, livestock, cargo. For that one, lot of, in case of exports, or the people are going abroad, the passenger exports, foreign ships and foreign aircraft come to Sri Lanka. Then foreign airlines and foreign shipping companies come to Sri Lanka and they ආවෙලා තියෙද මේකේ? මේ රෙකෝඩ් එක ඇරවනේ. අපි සොල් කියන්න ඕනේ දැන් නේ. ඈ? Continue. Hurry. Sorry, I found some technical defects. The last 5-10 minutes has not been clear. You can listen, but again I am going to discuss that part. Chiran, මම පොර නවත්තන්න ඕනේ. පොරකට හතරට නවත්තන්න ඕනේ. All right. Right. For that part, I prepare other handouts for you and time 3 past 35. You could listen to me, and for that I prepare other documents, and we will next day I will give it to you. Then you can read. Then I explain how to tax the non-resident companies, especially how to tax the airlines, shipping companies, insurance companies, and also how to charge the income tax from the non-resident companies where the profit is remitted, and also the profit is full profit is taken it away. In corporate tax in Sri Lanka, in domestic companies, once their profit is distributed, they pay dividend tax. In case of foreign companies, non-resident companies, once the full profit is taken out after paying taxes, that full profit is taxed at rate of 10% and treated as the remittance tax. The remittance is we deem as a dividend. In case of non-resident company, full profit is remitted means their full profit is taken away by way of dividend. Then we apply the rate of 10%. Right? On that way, foreign companies are taxes. And also, there are some situations where commissions are not in a position to ascertain the correct profit of the certain businesses. Say a lot of large construction contractors in Sri Lanka, they make an argument they are not in the position correctly compute their profit. Then Commissioner General discusses with these companies and apply some percentage of profit to the total value, and they say the contract value 1,000 million, the Commissioner General apply the 8% of profit. That means the 80 million is the profit. They are not preparing any accounts for their business. Only agreed 8% of the section provide Commissioner General should apply at least 8% of profit for the total turnover. Then if the contract value is 100 million, 1,000 million, the Commissioner General applies 8%, then profit is ascertained as 80 million, they apply the rate of 28% or the applied rate and collect the taxes. For that 80 million amount of tax paid is deducted, and residue we apply the 10% of remittance tax for the residue. Right? On that basis, remittance tax is charged. The remittance tax is equal to the dividend tax. Dividend tax. Right? On that basis, there are so many provisions for the Inland Revenue Act for the taxation of the non-resident companies, and especially shipping and the airline companies, and also the insurance companies. All companies has to pay profit tax on their taxable income, and also the remittances for their full remittances. In addition to that, there are in some cases there are some restrictions for the deduction for the expenditure. For in case of non-resident branches where their accounts are prepared, the head office expenditure are limited according to the Inland Revenue Act. They can't deduct full amount of head office expenditure. In the same way, for a business of leasing, full amount of bad debts cannot be charged. There are some restrictions. Likewise, there are some restrictions. All those to be considered once the profit is computed in order to compute the taxable income. After compute the taxable income of the companies, the relevant rates to be applied. Right? This Word document carries the income tax rates for the corporate tax 25 year of as of 15 and 16. Say the profit from say that any company engaged in the business of educational service are chargeable at the rate of 10. Say the normal corporate tax rate for the Europe as 15 and 16 is 28%. But if the company has engaged business educational service or the provided educational service and derived the profit, such that in such business we compute the adjusted profit, compute the statutory income, assessable and taxable income, apply the rate of 10 or the 28%. And also profit from agricultural undertaking referred to section 16 of the Land Act are chargeable to tax at rate of 10%. Right? The section 48A very especially state the rate of 10%. Normally tax rates are applied in the first, second, third and fourth and fifth and sixth schedules of the Act. The imposition section also mentioned that tax shall be charged as rate specified in the first, second, third and fourth and fifth schedules of this Act, etc. But in the body of the Act also, in some section also clearly state the applicable rate of taxes. Say the profit of educational services are charged with the rate of 10%. And likewise in this Word documents, I have given some rate is applied for some profit of some companies. If they say that if qualified export profit of the companies is taxed at rate of 12%. Say the venture capital company is chargeable to tax at rate of 12%. Say profit from locally manufactured handloom produce is chargeable to tax at rate of 12%. If that profit is more than billions of billions, we apply the rate of 12%. Same that profit of a grower or manufacturer of tea who has established joint venture with the tea exporter is chargeable to tax rate of 12. Then here I have given rate applicable for a certain type of profit of the businesses, right? Then rate, this type of rates to be applied. When we can apply the methods to compute the adjusted profit, assessable and taxable income. Once we compute taxable income, these says to be applied in order to compute the tax payable of the company. But dividend tax is not changed, still it is remained as 10%, though the taxable income is taxed as different rates. And also the small companies are taxed as constant rates of 10%, and this might have given some example how to tax that type of situation also, and you can read this Word document and you can get some all insight. Right? I am going to sum up the session for today. I am kindly request you all to read all those Word and my PowerPoint document related to corporate taxation. And next time I upload your website the first assignment, right? Then I am going to close. Thank you for listening. Good evening.